Real estate insolvencies in Canada are now on track to surpass levels of the 2008 global financial crisis. And the buyers who trusted these developers are losing everything. The numbers are staggering. There were 283 bankruptcies and proposals in real estate and construction in a single quarter of 2024. That's up 43% from the same quarter the year before. Real estate now accounts for 55% of all receiverships tracked by Insolvency Insider Canada, up from 30% the year before. The highest profile collapse is The One, Sam Mizrahi's luxury condo tower in downtown Toronto. Lenders are owed $1.6 billion. The project stalled. The money ran out. And the buyers who put down deposits are fighting to get their money back. But The One isn't an outlier. It's the tip. Dozens of developers across the GTA and Metro Vancouver have filed for bankruptcy protection or been placed into receivership in 2025 and 2026. Vandyk Group, StateView Homes, Track Developments, Sunrise Acquisitions, Ashcroft Homes. The list keeps growing. In British Columbia, the thinned properties situation tells the story perfectly. Multiple massive condo projects in Burnaby were forced into creditor protection after the developer couldn't service its mortgage debt. The Eclipse tower is 95% complete, but construction stalled. 224 pre-sale buyers are trapped. Some spent years saving for their down payments. One buyer, a barber, saved nearly $40,000 at $40 a haircut. Now his deposit is locked in a legal fight. So what's causing this wave of developer bankruptcies? First, interest rates. Developers finance construction with short-term loans that are much more expensive than residential mortgages. When the Bank of Canada raised rates from 0.25% to 5% in 18 months, the cost of carrying a development project doubled or tripled. A project that was financially viable at 2% financing becomes unworkable at 6%. Second, construction costs. Labor shortages have pushed wages higher. Building materials remain elevated even after the pandemic supply chain disruptions eased. Municipal development charges in Toronto exceed $100,000 per detached home. When you add rising financing costs on top of rising construction costs, the margin disappears. Third, pre-sale demand collapsed. During the pandemic, investors bought 3 out of 4 pre-construction condo units in the GTA. They expected to flip them at closing for a profit. When prices dropped 9% and rents fell, those investors stopped buying new pre-sales. Without pre-sale commitments, developers can't secure construction financing from banks. Without financing, projects stall. Fourth, the population decline. Canada's population shrank for 2 consecutive quarters. Immigration, which drove housing demand for years, has slowed dramatically. Fewer people means fewer buyers, means less demand for the thousands of units these developers plan to build. The ripple effects hit ordinary Canadians hardest. Pre-sale buyers who put down deposits of $50,000 to $100,000 on units that may never be completed. In Ontario, Tarion provides some deposit protection, but the coverage has limits. In BC, deposit protection depends on the structure of the project and the legal proceedings. Many buyers are learning that their deposits are unsecured claims, which means they're last in line behind banks and other creditors. The irony is brutal. Canada desperately needs more housing. CMHC says 6 million new homes by 2030. The Carney government pledged 500,000 per year. But the developers who are supposed to build those homes are going bankrupt because the economics of construction no longer work. Development charges make building expensive. Interest rates make financing expensive. Permitting delays make timelines unpredictable. And the demand that would justify building has evaporated in the markets where housing was needed most. This is the paradox at the heart of Canada's housing crisis. We need more homes, but the conditions make it financially impossible to build them. For buyers, the lesson is painful but important. If you're considering a pre-sale purchase, do extreme due diligence on the developer. Check their track record. Check their financing. Check whether the project has construction financing secured. And understand that your deposit is at risk if the developer fails. For the broader market, the developer bankruptcy wave means fewer housing starts in 2026 and 2027. That could eventually tighten supply and push prices higher in the long run. But in the short term, it means unfinished projects, empty lots, and families who trusted the system left with nothing. Have you been affected by a developer bankruptcy? Drop your story in the comments.